Okay, I think we're ready to get started, and hopefully this is being recorded correctly here. It looks like I've got something different. I apologize for the brief delay. It looks like we've had this a couple times in a row now. We had to have something from AV come up, and excuse me, install a new version of Zoom, and we had this problem in a different room yesterday. I didn't think it was something that was going to be recurring, but I guess that it is. And so anyway, so here's where we are. So for today, we're going to cover the rest of chapter 6, and that deals with national income accounting, and we're going to finish that up. And I think probably beginning on Thursday, we'll get into unemployment, and we're pretty much where we need to be. I think that I thought we'd get through chapter 8 this week, and I think that we may very well. I think there's a good chance we'll get all the way through that. We'll be really right on track with where we ought to be. So, are there any questions for me about anything before we get started here? All right. Well, just real briefly, I just want to review just a little bit here where we are and where we left off. And so we were talking about national income accounting. That is, how do we account for all the activity that goes on, all the economic activity that happens throughout the economy, and is there some giant computer that captures it? And there really isn't. So it's mostly historical information. And we said there are two approaches, and one of these is the expenditures approach, which we went over, I believe, last Tuesday, and I think actually Tuesday and Thursday, and we sort of finished that up on Thursday, and then we started again. The second approach which is the income approach. So again, just to sort of reiterate what's going on, the expenditures, if one person's spending equals another person's income, sort of hypothetically, it's hard to say. I know that sometimes economists will say my spending is your income, your spending is my income, and that's not to be taken that literally, but nonetheless, someone's spending results in your income, and your spending results in someone's income somewhere, because a dollar spent somewhere in the economy results in income somewhere else. And this is why these two sides of the measurement have to balance each other. They have to, because it theoretically is not even possible for them conceptually to do otherwise. So spending must equal income. So this is the demand side of the economy. We got into that last time, and we sort of linked that back to the notion of the circular flow model and all the actors doing all the demanding. Those households, firms, and governments, because they all buy and make expenditures. And so we don't a lot of times think of the government as being on the demand side, but they really are. And we're going to get into that a bit today when we get into some of the numbers. And I pulled up some of the actual accounts from the national income accounts, just to sort of show you how big these numbers are and whatnot. And then we got into the income approach, which is the supply side of the economy. So someone's spending equals someone's income, somewhere in the economy. And one thing I want to say about income, and I don't know if I stressed this too much last time, but for those of you who had an accounting course before, I want to make sure that you're not confusing accounting or income with profit, because I think that's a very common misconception, and there's an easy one to do. And I know that there are all kinds of areas in economics where we say, okay, this is the way they do it in the accounting world, this is the way we do it in the econ world. Income is a very inclusive number that basically captures inflows. Whereas if you study accounting, net income is usually the bottom line profit. Sometimes pre-tax, sometimes after-tax, doesn't matter, because we're not interested in profit here. We're interested in income, and that is the inflows to a business firm, to a government, to a household. Just the inflows. Doesn't matter what the residuals are. Doesn't matter what savings are. We're going to get to savings a bit later. These are just gross inflows, because gross expenditures must equal gross inflows. And that's really the important thing that we were trying to emphasize here, was that issue of expenditures equally income. And I talked about last time, this is one for last week as well, so I forgot to give that to everybody. So anyway, so questions about that? Well, let's do this. Let's pick up from where we left off last time. Let me bring the lights back up here. And I want to get into some of the income approach. And one of the things that I mentioned on Thursday, and it's something that sort of bears repeating here, is that the income approach, and by the way, I'm reminded every time I look at the national income accounts just how expansive that they really are. And one of the things that comes to mind is the fact that there are lots and lots of categories, and I cut a lot of them out deliberately. And so if you are trying to match this up with what you're seeing on the screen, and when I get into the BEA website, it's probably not going to match perfectly. And I'm doing it deliberately so that we're making this abbreviated, because this goes on and on and on in terms of different categories. And so I want to sort of make this a little bit more apprehendable. So the income approach is, again, the supply side of the economy. And in other words, who's doing the receiving of the income? Income, again, being not a profit figure, not a wage, but simply an inflow, okay? So we started out last time with GDP, and I actually went through this idea of taking out the net foreign factor income in order to arrive at GNP. That's important, but it's not that important. So I'm going to right now go back to, and I'm just going to sort of pick up from where we left off last time, just real briefly here. Consumption of fixed capital. I know we went over this last time. This is the same as depreciation. And you arrive at net domestic product. And then we do a plus or minus, depending upon what value this is, of what's called a statistical discrepancy. And this is where we get into this idea of, I guess, fudging the numbers if you like, but it's a very small number and it's not small, it's in the billions, but it's not big in percentage terms in relation to GDP. If it were like 20% of GDP or something, yeah, we have a problem where we're trying to balance the income side with the expenditure side. Because here's the issue. I mean, there are a lot of issues with trying to balance the expenditures approach with the income approach. First of all, there are timing issues. Sometimes we don't always know the income approach, and sometimes that is revised later on down the road with tax return data, quite frankly. And tax return data, believe it or not, I know this sounds incredible, is actually pretty accurate. It usually captures pretty much what's going on, because most people really can't conceal their income, and businesses really have no incentive to, despite what maybe we have heard over time. So that statistical discrepancy is just a way to get these numbers to match, okay? And this is where we left off last time at national income. National income is basically corporate income for the most part. And I know that if you have taken a business course before and have gotten into this distinction between corporations and partnerships and proprietorships, that those three main forms of business entity, you might be wondering why corporate income is sort of singled out here. And it really is because of the fact that it's really the dominant form of business structure. I know there are more sole proprietorships than there are corporations, but but these sole proprietorships oftentimes are very, very small, one-person operations, or any kind of unincorporated business of any size usually becomes incorporated simply because of the legal issues and the legal protections that are afforded to corporations. So this is basically business income. So what we're doing in the income approach is we're taking this big pie that is GDP, and we're sort of dividing up who gets it, right? The last pie that we had was who does the spending. This is who gets it. So we're talking really about business income here. And then we have to take out some things, and we're going to take out, this is a minus sign, import taxes. Import taxes are also known as tariffs. We take them out simply because they're not really income earned, but it's money that flows to the government. So, and oftentimes it's paid by consumers. And if we have more time in this class, there's a more comprehensive discussion about imports and exports and trade, international trade in general. If we have time, we'll sort of get to that. Okay, maybe I got to this last time, I don't know, but then we take out Social Security contributions. And these are, when we say contributions, this is sort of a euphemism for the word taxes, really, contributions. Because the law that dictates Social Security contributions is called the federal, what's it called, the FICA tax, which is Federal Income Contribution Tax, right? Income Contribution Act, I guess. So it's FICA. The FICA tax it's called a contribution, but it's really a tax. Okay, so we take out contributions. Now, here's the thing about Social Security taxes, is that it's a unique form of tax. And it's also, we can include Medicare as well. Social Security tax and Medicare tax are really taxed together, but it's split in half between employer and employee. Social Security taxes are about 6.2% of income, up to a certain cap, and that's split between, and so the employer pays that 6.2%, and the employee pays that 6.2%. And if you're self-employed, you pay the whole thing. And you may get to deduct half of it down the road, but still you've got to pay it. That's one of the issues of being self-employed. Medicare is split 1.45% to the employer, 1.45% to the employee, and there is no cap on earned income. Earned income is, in terms of self-employment income, wage income, would not include things like investment income or rental income or something like that. So we have to take those out. Now, what's interesting about this, we're taking this out of total amount of production, but we're going to bring it back in later. And I want to make sure that we're aware that we're going to do that. So then we take out corporate taxes. Remember, if we had corporate income here, we're working our way down to how we divide this pie to firms, households, and government. So some of this is government, import taxes, Social Security contributions or taxes. It doesn't really feel like a contribution because it's mandatory. And by the way, what if you die at age 35 or whatever, and you've worked your 40 quarters, 10 years basically, and you have no spouse or dependents, that money is gone, right? It's not like an IRA or a 401k where the money's there and somebody will get it. Nobody gets that except the government, so it's a tax. So corporate taxes, money coming out. And then we take out of this something which is earned but not recycled back in the economy, because we're working our way down ultimately to the household. And that is undistributed corporate profits, which in the accounting world we call retained earnings. And that is that businesses generate sales or income, as we are referring to it here, sales or revenue. And yet not all of it gets recycled back to the economy because businesses simply hold on to it. And why would they hold on to it? They would do it because maybe they want to reinvest earnings into things like capital expansion, inventory expansion, bonuses. Increasingly in the last few years, companies have been paying out bigger, doing stock buybacks in order to boost their stock price. It's been sort of controversial in some regards. So undistributed corporate profits, okay? We're working our way, so government is picking up a piece of the action here. This is basically business income, but then government's picking up its piece of the action through taxes, import taxes, Social Security contributions, and then there are all kinds of other taxes. And one of these is what we call indirect business taxes. Indirect business taxes. And what is that? Well, this is really where state government comes in. And that is indirect business taxes are basically sales taxes and excise taxes and taxes on specific goods. And it's indirect because it's a tax on the company, but really it's often paid by the buyer. And for those of you who will take or have taken micro before, there's a whole discussion that we get into as to how this tax, the sales tax, is divided between buyer and seller, if it is divided. And I know that sometimes people say, what do you mean it's divided? If I go buy a toaster for $20 and the sales tax is 6%, then I pay 6% on top of the $20. I, the buyer, pay it, but not necessarily, because it can be divided up between buyer and seller, because sometimes sellers will simply lower the price of the good. And the government, which is the state government primarily, is indifferent as to who pays the tax. As long as the tax is paid, then it doesn't really make any difference. But this is really how state governments receive lots of their funding. And when we get into the numbers, you're going to see how state government is a very large portion of GDP. And this doesn't sound, it sounds counterintuitive, because particularly for those of us who've done our own taxes, income taxes, we pay a lot more in federal income taxes than we do in state income taxes. So it seems like every state is kind of a little bit maybe the minor leagues as opposed to the federal. But in essence, how do state governments raise a lot of their revenue? They raise a lot of it through sales tax. And we just are simply accustomed, if we go to the store and buy something, we simply pay the tax, right? It doesn't seem like very much money, but every transaction that you're doing is pretty much subject to tax. And again, we talked about early on in the class the idea that local government, which is county, local, and in some places there are even further subdivisions like parishes and townships. All of those are extensions of state governments. They're sort of subsets of state governments. So they derive their income from the state. So sales taxes flow to the state and then they get redistributed back to counties and cities and all that. Even if it's a city tax, in Bernalillo County, we have a little bit of a higher sales tax than we do in some of the neighboring counties like Sandoval and whatnot. So some of that gets redirected back. So indirect business taxes are sales taxes, but also things like excise taxes. Like there are some goods that just sort of are natural targets for additional taxation. What kind of goods are we talking about? That just we pay lots more tax on them than you do for the aforementioned toaster example, right? What kind of goods are really just almost raise their hands saying tax me, right? Gasoline is a big one. Cigarettes, all these. And those are two taxes where the federal government does get involved. in those. They do get involved. And so that's the interesting thing about it. Okay. All right. So questions about that. Now, one final bit here. And again, I know that if you pulled up the income approach, if you just Googled it, type in income approach, you'll see all kinds of things like foreign inflows and outflows and things like trade credits and drawing rights at the International Monetary Fund. I know that we're cutting out bits and pieces of this. I understand that, but we're doing it in order to get back to where we're moving here. We said that this is the business sector receiving its share of the pie. This is government, and we're going to get to the personal part of this in a minute. And we're working our way down to the household level, and that's where we're going to be spending some time a bit later in the class when we talk more about household behavior. Because remember, more than 2/3 of spending in the economy is households, and so households are a big part of the whole picture. Okay, so here we've got all negatives. These are all subtractions. Now we're going to add back something, which is sort of a movement one way and a movement back the other way, and that is this guy here. Social Security and Medicare are given back in the form of transfers, but these are not equivalent. These don't cancel themselves out. People pay more into Social Security than what we're currently taking out as transfers. Now, let me define what transfers are, because transfers are more than Social Security. Transfers are one of these areas in the circular flow model to which there is no reciprocity, okay? There is no red arrow going in the other direction. So if we were just to kind of model this out here and show what this looks like, just real briefly here on the circular flow model, and again, right, circular flow models can be as limited as you want or as detailed as you want. So you've got households over here, and you've got government here, and you've got firms here. And we know that we've got a red arrow and a green arrow and all that. And so if you've got, firms paying wages here and households doing spending here, which we'll call consumption, right? And we've got goods going in the other direction. So we've got goods here. We've got labor going in that direction. This is nothing new here. Well, here we've got a one-way thing going on, and that is transfers. So what is a transfer, and what is the definition? A transfer is simply a one-way movement of money from government to households. Now, there can also be transfers to businesses as well, and we certainly saw this enhanced during the pandemic when the government sort of stepped up some of their transfers to businesses with a number of different programs under the CARES Act and some of the other programs that the Biden administration and the Trump administration prior to that enacted. But primarily, we're really talking about one-way movements. There's no red arrow here because you don't have to do anything to get these. You just have to be eligible. What are we talking about? We talk about transfers, because I think this is an important thing to talk about. And then we'll come back to this, but I think this is a good place that we focus on because it comes up again and again in our discussions in this class. So transfers, again, defined as a one-way movement of money that you don't have to do anything for, you just have to be eligible. And I realize when I say you don't have to do anything for it, those are sort of fighting words to some, because of the fact that to get Social Security benefits, you have to be eligible and you primarily have to pay taxes into it. This is certainly the case with retirement pay. That is, if you're at a certain age, you could draw benefits. Because I think if you told somebody, hey, you didn't have to do anything to get those benefits, they'd say, what do you mean I had to work for X number of years? And that's true. I mean, you do have to work, you do have to pay into it. And the more you pay into it, the more you get out. And again, it's shared between the worker and the employee. And if you're self-employed, you pay the whole thing. And by the way, if all your income throughout your life is investment income, you're probably not going to get very much Social Security because of the fact that you didn't really pay very much into it. But then again, if you have mostly investment income, then maybe you don't really need the Social Security. So that's the issue there. So it's a benefit, you just have to be eligible. Now, having said this, not all benefits of Social Security are retirement pay, what we call the old age survivors insurance, OASI. That's what we think of. And again, we probably wouldn't use that term today. It sounds kind of awkward, old age survivors insurance, but that was the original term, OASI, for the benefits. And it was set up for people when they got to a certain age. 65 was the sort of the magic number. That's not really the case so much today to get what are quote unquote full benefits. But even that term is a little bit misleading, because what does it mean? It scales up and down depending on how early you take those benefits. So, you can wait till 70 and get a bigger benefit, right? But 65 was always the magic number. But that 65 came from 1933 or 1935, I guess, when this program was created. What about the age of 65 in 1933? Well, that's about life expectancy in those days. I mean, you didn't, unfortunately, people didn't live too much longer than that. And today we sort of push that back to, it's about 77, 78. Females live longer than males, and that's been the case for forever, and it's all across the world. And I don't know what the reason why women live longer than men. I have no idea what the issue is. I know for a long time people tried to say, well, men have more dangerous jobs and they die on the job, but you can't even say that anymore because that's not even the case. So anyway, it doesn't really make that big of a difference. We're talking about the fact that people are living longer in general. This is a topic of never-ending debate as to what to do about it because these are not equivalent. We're paying more in now, but we're taking some out. But then this is expected to maybe reverse itself as the baby boom cohort is working its way into retirement. And I'm in the very tail end of that. I'm not drawing Social Security. I'm not old enough yet. But you kind of get the idea that we're going to hear lots more about that. So Social Security is one of those. Also, another form of training. Oh, and by the way, it isn't just the OA. I know where I was going. OASI is that one that we hear about. But it isn't just that because there's also a disability benefit where you can start drawing disability benefits at really pretty much any time. Like injured, sick, can't work, can't earn income, that benefit is there. And then once you get to a certain age, if you're still living after your disability period is over, then it goes to the OASI. There's also a death benefit, particularly for those who have minor children and whatnot. There is a death. I guess we're boring somebody here. So
mute yourself.
Huh?
Mute yourself.
Yeah, I'm gonna mute here. So I'm sorry I'm boring everybody. So there is a death benefit that's paid to minors and to surviving spouses, particularly minors. What's that?
Zoom is handy. I was late, but I was on the Zoom call the whole time.
You were on the Zoom call?
Uh-huh.
Oh, that's kind of, well, we got started late because they had to put in new software, which is kind of weird. So, but anyway, this is an important benefit, something to talk about, and it's related to Medicare benefits. Medicare is a form of transfer. You don't have to do anything for it. You just have to be eligible. Medicaid is another benefit. Medicaid is a little bit different than Medicare because it's a federal and state program sort of jointly administered, mostly funded by the federal government, but also sort of split with and administered by the states, funded by the feds, administered by the states. Medicaid, also things like unemployment benefits are another example here. And so we're going to talk more about unemployment on Thursday, and we'll talk a bit more about unemployment benefits, but we're not going to get into great details of this, but unemployment benefits are a transfer. You don't have to do anything to get it, you just have to be eligible. And yes, I realize that there's some reporting requirements. I believe it's a weekly reporting requirement that you have to do, basically saying, yeah, I am looking for a job and all that. And we'll talk about this more when we get into chapter 8 on Thursday. But these are transfers. They're simply one-way movements of money, primarily in households. Yes, there are firm transfers, but we're not really going to get into those business transfers here. The other thing is the entire panoply and collection of what we call welfare benefits. And they include things like food assistance and student aid is another example, housing assistance, mobility assistance, transportation assistance. I mean, the list goes on and on and on and on. I bring up food assistance because that's a big one. SNAP and TANF and WIC and all these programs at federal levels, at state levels, all of these are programs designed to provide for needy families. And so those are all transfers. So why do we add those back? Because we're working our way down to the household level. They've got to be funded primarily somewhere, and it's through the production of GDP. And so again, we're taking this pie, we're sort of dividing it up, okay? And we're sort of working our way down to the level of the household. And so since I'm out of room here, I'm just going to draw a little arrow here and say, okay, we've got transfers, right? So let's just pick up with transfers. And so we arrive at a value we call personal income, or PI, personal income, okay? What is personal income? Personal income is the portion of GDP earned by households prior to tax. This is before tax income of households. Income before tax is personal income. And the rough equivalent is taxable income on your tax return. It's not quite the same as taxable income because taxable income does some things like take some things out that you've actually earned, like your standard deduction, for instance, this is money you've earned. You just don't pay tax on it, right? And I don't want to get too deeply into the whole tax issue because, I mean, well, first of all, it never really ends. You can start talking about taxes and get off into all kinds of hallways and doors you don't really want to get into. All I'm simply saying is that personal income is essentially your gross income that arrives at households. Now, what is it? It's wage income, it's salaries and wages. And by the way, in economics, the term wages is sort of a euphemism for all earned income that you earn as an employee somewhere. It's a very comprehensive term, even though I think in the real world, we tend to think of wages as being hourly wages. And for those workers who are considered to be non-exempt, that is, they have to account for their time, either through punching in or logging in or something, or recording it, writing it down. And the government's got some very detailed examples of who is exempt and who's not exempt. That is exempted. Well, first of all, who doesn't have to report their hours? That they just simply show up and they get paid the same wage. What kind of salary workers who tend to be of what sort of classification within an employer? Like what kind of jobs are we talking about? Well, management and professional staff, right?
Oh.
Management and professional staff. If you're a manager, you tend not to. If you're on a salary, you don't report your hours. So if you're supposed to be at work at 8, you get there at 8:15. They're not going to take 15 minutes of pay away from you, unless they're really. I mean, I can't imagine them doing that because you're on a salary, right? Likewise, if you're supposed to get off at 5, you have to work till 8. You're not going to get paid 3 hours extra either. So that's one of the things about salaries. So we would incorporate salaries into wages. Okay, so salaries and wages are all, and bonuses, tips, commissions, all that would be considered a wage. Then self-employment income. So if you have a business, rental income, investment income, all these things that go into this. So it's a big category. It's wages, salaries, commissions, bonuses, tips, rental income, investment income, all this stuff that goes into that. Okay. It would not include gifts, and so let's take that out, okay? And then one final category here is personal taxes. And we're talking here primarily about personal income taxes, both federal and state, okay? So personal income taxes come out. And so we have basically now done everything but sliced and diced the economy to arrive at the bottom line here. So once we take out personal income taxes, then we arrive at something called disposable income, or DI, disposable income. So a lot of times we'll refer to this as PI. And I sort of hesitate to bring that up because PI also stands for price index. And we're going to get into that in chapter 9. But disposable income is the after-tax portion of income that arrives at households. And again, you've paid all your taxes. You've paid sales taxes on all your purchases. You pay real estate taxes. That's a form of indirect business tax, really. You've paid personal taxes to the government, both federal and state, and sometimes there's a local tax, which is usually collected by the states. And so now you get yourself down to disposable income. And so we've worked our way down. And by the way, this is not usually disclosed on the national income accounts because it takes a while to sort of update these. And even years later, people are doing amended returns and whatnot. So out of this figure, you've got disposable income, and there are only 2 broad categories of things that people can do after they receive their disposable income. And what is that? There are really only 2 things you can do with it in very broad terms.
Save it or spend it.
Save it or spend it. In other words, you can channel it toward consumption, or you can channel it towards savings. And those are the only 2 categories of things you can do with it. Consumption, spending, or savings. Not investment spending, because investment spending is a function of businesses. And even if you buy stocks or a mutual fund or put money into a 401k, that's a function of savings, not a function of consumption. By the way, one category that comes up here, and sometimes people will say, what about charitable contributions? That's a good question, because the charitable contributions don't seem to fit this category. But what are they really? They are really an act of consumption. All that you're doing with charitable contributions, you're sort of channeling your money to an entity that will eventually turn that into consumption very, very quickly. Okay. So one thing about savings, we're going to circle back to this because savings plays an important part, particularly at funding long-term growth in the economy. And that is, what is savings? How do we define savings? Because savings, and I want to be clear that we're not talking about savings accounts necessarily, although it would include savings accounts. When we're talking about savings, we're saying these are two definitions. That number one, it results in what we call deferred consumption. That is, what we don't spend now, we necessarily are saving. Any part of our disposable income that we don't spend, we save necessarily. And when we talk about savings of this, we're talking about somebody who is not channeling and not recycling income back into spending. And this is both interesting and good, and also a bit problematic as well. And we're going to talk a bit more about this. And in fact, we saw this topic come up during the last recession, 2008, 2009, when people were saving like crazy. And what if everyone saved like crazy? What would that do to the economy, do you think? Well, it would slow the economy down, wouldn't it? And that's what's called the paradox of thrift. It sounds like savings has got lots of virtues, and it does. But it sounds like, hey, if we all saved more, we'd be in great shape. But the problem is, when we do it, we short circuit the income and spending cycle because we're not spending. And just think about this, and I'll give you a ridiculous scenario. But sometimes ridiculous scenarios actually play out in real life. But this is really ridiculous. Let's say that Albuquerque is sort of like a Gilligan's Island. Nobody comes in, nobody leaves. And so let's forget about money coming in, money going out. And we all decide that we are on strike as consumers. We're not going to spend money. So for the next month, we're going to show the businesses, we're going to teach them a lesson. We're not going to buy groceries and we're not going to buy gas. We're just going to walk to work and we're going to eat tree bark and leaves and cats and dogs and all that, right? And we're not going to buy. So what happens to the local economy? This sort of Gilligan's Island economy. Well, first of all, inventory stacks up on the shelves. Businesses have to lay workers off because nobody's buying goods. So if nobody's got income to buy anything, then nobody's doing any spending. And so as a result, the economy essentially falls in, caves in on itself because of the fact that people aren't spending. And this is really the issue with savings, is that there's a paradox of thrift. And by the way, I'll give you a non-ridiculous example that's played out for many decades. And that's the case of Japan. The Japanese consumer is a sort of world-class saver. And for whatever reason, I don't really know, other than the fact that I think it's more of a kind of a cultural thing, and real estate's expensive, and so you have to save a lot for down payments. They have like 100-year mortgages in Japan because real estate is so expensive. But the problem is that because they have such a high savings rate, it took them about 20 or 30 years to get out of a recession, simply because they could not get people to spend money, because people were saving, and it was just cutting off the income and spending cycle. The government was even doing things like issuing coupons to go buy things like washing machines and other kind of durable goods. We'll give you a discount on it. Go buy a washing machine. People wouldn't do it, And it took a long time. Japan is sort of back to where they were economically, not before the pandemic. I'm saying before the 1990s sort of thing. So where the 80s, they were going big guns. Then sort of slowed down. The Chinese economy sort of caught up and overtook them. So that's the first definition of savings, and that's a bit of a problem. We're going to come back to that. We're going to circle back to this relationship a bit later, but it's important for us to understand. So yeah.
Isn't it a really bad thing too when everyone tries to pull their savings out at the same time?
Well, that would be another issue too. What if everybody went to the bank and pulled out their savings? What would happen?
The banks go bankrupt.
The banks collapse, right? And if you've ever seen the movie It's a Wonderful Life, it's a nice Christmas movie where Jimmy Stewart's a little local banker, and everybody wants their money out because the big bad banker across the street, they spread a rumor that the savings loan is about to fail. And so everybody wants their money out, knowing that it would not be there, because if everybody wants their deposits out, the bank fails. And that's something that's important to understand, and which sort of leads us to our second definition here, and that is that money in savings is deposited with financial intermediaries. And by the way, this idea of banks failing is, historically, it's not that uncommon. Now, it's been sort of uncommon in the last 80 years since the Great Depression. But had we not had a lot of governmental safeguards, I think some banks definitely would have failed in 2008 when you had failures of investment firms, right? And the government just let them fail. Bear Stearns, you're gone, doomed. They're doomed to failure. But not the commercial banks. The commercial banks were put in place, were saved. So what does this mean? Deposited with financial intermediaries. Well, we're going to get into a bit more later this idea of what a financial intermediary is. A financial intermediary, and we're going to add that to the circular flow model, is simply some sort of financial institution that receives people's money and invests it. So that's part of it. It says, are you intermediaries? Yes.
How do you spell that? How do you spell it?
INTERMEDIARIES. So
What? Yes.
INTER.
Isn't that what happened during the last recession? Is that everyone was saving and then they were afraid.
The paradox, the paradox of thrift. INTERMED.
And then the banks were bankrupt and had to be bailed out.
Yeah. So in the last recession, 2008, when banks. So what happened, and I know there was a lot of observation about this at the time, was that when banks began to fail and investment firms began to fail, and you also had like major car companies needing a big bailout. Just when GM went bankrupt, General Motors. I mean, I grew up in car country, the upper Midwest. General Motors failing is almost like.
Bye-bye Pontiac.
What's that?
Bye-bye Pontiac.
Well, General Motors failing is almost like, taking away football or, no more TV sets, or, it's just unthinkable. But it went down. They took bankruptcy. They still exist, but they took bankruptcy, reorganized. But people said, okay, well, the economy's bad. I'm going to save. I'm going to hoard my money. And so as a result, they were channeling more to savings than they were to consumption. That slows the economy down. Because every dollar that goes to savings is a dollar that's taken away from consumption. Because remember, this spending here is about 2/3 of GDP, more than that. Because by the end of the recession, it was about 72%, which is greater than 67%, which is 2/3. Mostly because business investment had fallen off a cliff. But that's what happened. People began to save. Now, by the way, we know this too because when the government did the first of a series of stimulus checks actually they were around during the second Bush administration, but they sent out 3 checks. The first 2 were basically early tax credits, but the last one was during the financial decline that was brought on by bad mortgages and all that. And the government sent out a check, and it was just money from the sky, kind of like what was done during the Trump and Biden stimulus checks. And what happened, the government thought, okay, people are going to spend that money and that'll boost the economy. But instead, what people did was they saved it for the most part. Yeah, sure. I'm sure a lot of people did spend it, but more people saved it than what they expected. So it didn't really have the result. So this is why that recession took a long time to get out of. And it did take a long time. It took us years to go from the depths of that recession in 2009 to get to full employment. And that's a very long climb out. And we're going to talk about this when we talk about stimulus and fiscal and monetary stimulus. That'll come a bit later. But that's part of the issue with savings, is that it's a good thing and it's a bad thing. So this is why it's called the paradox of thrift. So when we talk about financial intermediaries, the term banks come to mind, but it's not just banks. It's investment firms, it's insurance companies, it's mutual funds, it's investment firms, it's things like 401k savings. So the term savings here is kind of like the term wages. It's very comprehensive and it includes more than what you would think it would include. So it includes any kind of financial intermediary that's involved. Now, here's the thing, okay? Because this question comes up from time to time where people say, okay, well, look, let's say my personal income is $40,000 and I pay $5,000 in taxes. So my disposable income is $35,000. And what if, let's say I spend of that $35,000, I spend $30,000 and I put $5,000 in a coffee can in my backyard. That's savings, isn't it? Now, is that savings? Yes or no? No, it's not savings by which we define it, because what it's equivalent macroeconomically to something setting on fire, right? But yet people did this during the Great Depression. Why? Because they were afraid to put their money in financial intermediaries, particularly banks, because there are no backstops on banks. If a bank failed, there was no deposit insurance. And bank regulation was extremely lax. It was not even anything like what it is today. And so as a result, and even today, it's probably not where it should be, frankly, according to most people, and certainly in my opinion, as an ex-banker and economist. But if you bury it in the backyard or in your mattress or whatever, it is gone from the economy altogether. At least you could say, okay, yes, you've cut off the income and spending cycle by channeling it to savings, but at least it's there somewhere, and a bank could lend it out, or it's put to work somewhere in the economy. If you bury it in the backyard, it's gone altogether. Nobody gets any value out of it. And so as a result, that's money that is disappearing. This is why it's so important to have deposit insurance and other backstops so that people don't lose their money when they put it into a financial intermediary. Which is not to say that if they put it into an investment firm and they buy stock in whatever company and the company does poorly, they might not lose money. Where they won't lose money is when the brokerage firm, the investment firm won't go bankrupt because of another entity called the SIPC. And there are all these entities which exist so as to protect these institutions from not going under, so that people can have some kind of confidence and channel it into these intermediaries. This is why financial regulation is so important, and why this effort at deregulation, which began in the 1960s and ran through the 1990s, probably did more harm than good. And I was on the beneficial end of that, because when financial regulation really hit its peak in the 90s, I was in banking. I thought it was a great thing, but maybe I don't quite think that so much anymore. So you get the idea that it's important to talk about this idea of where this all goes. So what have we done here with the income approach? We've started with GDP, that is the entire big pie. We've worked our way down through the business entities. Government's picking up its share. We've gotten our way down to personal income, that is pre-tax income to households, taking out income taxes and arrive at disposable income, and then subdivide it further into consumption and savings. And so that's essentially the breakdown on where income goes, where it flows, et cetera, throughout the economy. So are there questions about that as to how we arrived at any of that? Okay, well, here's what I've done here is I've pulled up some data, and I don't think you can see that. Let me try to bring this over here if I can. What did I do here? Let me see. Okay, there we go. So I'm going to hit the lights here a little bit. So what we've done here, these are the national income accounts from the VEA website. And I'll hit the lights here so that we can see this a little bit better, particularly on the video. So this is, the VEA is an entity of the Commerce Department, federal government. And by the way, you can slice and dice this data however you like. It presents itself as quarterly, but I went ahead and hit modify and went annual. And you can go all the way back to, I think, 1929 if you want. The data is probably not that good from that era. But I went back to 2012, and we've got it all full year through 2022. And so what do we got going on here? This is the, so here we've got, remember, what are the categories? C plus I plus G, right? So they're a little bit out of order here. And, but you've got personal consumption expenditures, which, notice, out of a $25 trillion economy, we've omitted 9 zeros there, okay? So this is not 25,000, this is 25 trillion. 17 trillion is personal consumption expenditures. That's a big percentage. So I know a lot of times there's a tendency for us to think that, well, the economy is dominated in terms of spending by big businesses, but not so much, really. And households have got a definitely important role to play in this whole calculation. And then up there you've got goods. Remember the goods we talked about were durable goods and non-durable goods. What are these categories again? What are durable goods and what are non-durable goods? Does anyone remember?
Durable goods are anything longer than 3 years.
Anything longer than 3 years, right? Anything longer than 3 years. I'll bring this back up. I want to make sure you kind of move some things around here, since I'm having a little bit of trouble getting some of this back to where we need. Yeah, let me see here. I really wish they wouldn't mess with this. So, okay, so durable goods last longer than 3 years, so that's a pretty big number, right? Non-durable goods, everything else, right? Then services. Look how big services are in relation to goods. So goods about $5 trillion, almost $6 trillion in full year 2022, but services were $11 trillion. And so again, if we go back to this idea that this is not the minor leagues at all, in fact, it's really the major leagues. Services are big and they're growing quickly, right? They're growing it's almost 2 to 1 really in terms of contribution of demand. This is the demand side, okay? Gross private domestic investment, that's the I. So this is C, this is I. Fixed investment, that's things like spending on 18-wheelers and computers for businesses and copiers and fax machines. And then you've got construction, all this residential construction, all this other kind of thing here, residential construction down here. non-residential construction. Change in inventories is one we talked about, and this one is a positive. Inventories built up a little bit, and I suspect that's probably because the economy was sort of recovering from some of the supply chain issues, and so the inventories were building up, frankly. That's unusual because this is usually not that big of a number. Net exports, that's the difference between exports and imports. We import more than we export, so this is a negative. So this is a little bit out of order. I know we have C plus I plus G, which is down here, and then net exports, but nonetheless, it's the same thing. Federal spending, then government spending, the G, C plus I plus G, government spending, and this is federal. Like how big defense spending is as opposed as in relation to total federal spending. Most of federal spending is national defense. That is the majority. It's a big number, almost $1 trillion we spend on national defense, and the state and local, okay? So that's the expenditures approach. What about the income approach? And I'm trying to bring that over as well here. Let's see if we get that. Okay, so I did the same thing here. I went back to 2012. We start with GDP. This is, remember I told we cut out a lot of things. There are a lot of things we're cutting out here to sort of make this simple, even though it doesn't sound simple. We take out depreciation and whatnot. We get gross national. This is the net foreign factor income that I talked about last time. And I didn't include that today, but I talked about it the other day. That's the idea that we take out we have to add back in the income of foreigners who do business here, take out the income of domestic producers who do business around the world, because it's where the income is produced, not the nationality. The gross national product, gross domestic product is this taking out consumption of fixed product. And then we work our way down, we got government and net national product, and then national income. 2022's information is not all in yet. The year just ended, and then personal income, and it doesn't go anything below that in order to get to disposable income. Okay, so that's kind of a look there at what's going on with regard to that. So I'm trying to see here. I've lost my view of.
That was a government agency.
Sorry.
That was a government agency, the BEA.
Yes, it's called BEA, Bureau of Economic Analysis, and it's part of the U.S. Commerce Department, and they collect data on on all the activity in the economy. And by the way, I came in just in order to get to these sites. It's a very difficult website to navigate, and it's getting worse and worse all the time. I used to have an exercise where students would sort of tear into those and find certain data points, but it's just gotten so difficult to navigate that I don't even do that anymore. So, okay, so questions about those two approaches, expenditures and income. Okay, well, after we've done all this discussion about GDP and what it is and how we've estimated it and all that, what does it mean? And is it telling us anything at all? Is it a good thing? Is it a bad thing? What are the issues with regard? So I think we need to talk about the fact that there are some shortcomings with the measure. And this is important for us to realize. And let's talk about where this falls short and why it might not be a perfect measure. And beyond the fact that it's not like rounded to the nearest dollar, and we know there's some estimates, but it's pretty close. And particularly in terms of the rounding here has got to be small, even despite the size of the economy. Well, number one, it doesn't account for uncounted production. So the only thing we're accounting for here is what gets recorded somewhere in the economy. A sale from a business to a household or to another business or to government. Somebody's running away, somebody's buying gas. Well, what about the value of household production that's not accounted for? So what does this mean, household production? It's a pretty big, broad category, but what does it mean, household production?
Like household goods that are not.
Well, yeah, I mean, it's yeah, so think about this. So there are things you can do for yourself or things that you at home that have value, or you can hire somebody to do it. So you can clean your own house, or you can hire somebody to do it. And then if you hire someone to do it, then it theoretically gets counted in GDP, assuming that person reports it on their taxes. And maybe that's not always a safe assumption, but nonetheless, it's there. Right? You can paint your own house, you can fix your brakes or whatever, or you can hire somebody to do it. If you do that for yourself, then it's not accounted for in GDP anywhere, except for whatever you might buy in terms of materials and whatnot. So that's one area. By the way, household economics, there's a lot of different elements of this. Another part is like childcare. You can watch your kids yourself, or you can take your kid to a childcare center, which is no doubt going to get recorded somewhere, at least on the income approach side of things. And or you can have a babysitter or somebody who gets paid compensation. And so it's the same activity theoretically, right? Assuming that they do a reasonably good job watching your child, and it's the very same thing that you could do, right? So all these things are elements of household production, and so as a result, they're not accounted for. How big of a value this is really anybody's guess. I mean, I think that there's been a lot of work to try to uncover how much household production has value. And in particular, when it comes to trying to determine these household dynamics of maybe one adult in the household going to work and the other staying home, and then what is the value of that person staying home and doing things and saving money on not hiring things like childcare. And childcare is expensive; it just really is. And it's no wonder that people have fewer kids, just because the fact that kids are expensive anyway. But childcare is really expensive. So that's one issue. It doesn't account for any of that. I mean, if I build a deck on the end of my house, then I do it myself. The only thing that goes to the GDP is what I paid Home Depot for the screws and the wood and all that. If I hire somebody to do it, then it gets accounted for the whole thing. So we're missing some of that because it's just not reported. And why would it be reported? There's nobody to report it to. But yet it has economic value theoretically. Okay. Also, underground economic activity is not accounted for. So all this is uncounted. Underground economic activity. What are we talking about here? Underground. That sounds very shadowy, doesn't it? Yeah, money under the table. I hire you to, I don't know, clean my backyard, right? And and clean it up and plant some bushes and whatnot, and I'll give you cash, right? With the full assumption that you're not going to report your taxes and whatnot. And sometimes you'll run across people who want to be paid in cash, and there's a reason for that. It's because they intend not to report it. And I guess you're sort of aiding and abetting them when you do that. But then again, it's really their problem, not yours, isn't it? Right? But then again, that's uncounted because it's underground. It happens underground. I hire somebody to change the oil in my car, right? And then I give them $30 or whatever it is, right? And as a result, nothing gets really accounted for in GDP. They've done it. If I go to an oil change place, that all gets included in that. So underground economic activity. And then when we take underground economic activity, I think one thing that comes to mind a lot is illegal activity and how much is this? And again, the drug trade sort of looms large here because it's probably the biggest form of underground economic activity, but certainly it's not the only form of underground activity. There's a reason why it's underground. It's because it's illegal, and you'd be out of your mind to report that income on your taxes unless you can somehow make it look like it came from something legitimate, right? And even then, why would you want to do that? So the drug trade is large, as we know. In fact, I think we probably do not have all that great an understanding of how big the drug trade is. And some economists would say it's no big deal anyway, because if what we're trying to do is we're trying to account for the production of goods, then drugs are the production of bads. I know that we've talked about this before. It's sort of a play on words, but it's more than a play on words. It's maybe we're not creating value at all by creating illegal narcotics. And so you got to get the idea. Some of this is uncertain as to what it means. Okay. It also doesn't account for the changing quality of goods. This is a big one. This is a really big issue. It's been an issue for a long time in economics, and that is the idea that, okay, we produce $25 trillion of output, and are the same items that are produced today as good as the items that were produced 10 years ago, 20 years ago, whatever? Sometimes they're better, for sure, right? Televisions are better, computers are getting better and faster, cell phones do more, and they can, they don't cost as much, and they do all. So there's a lot of quality issues. They can do a lot more than what they used to do. But there are some goods that are probably not as high quality as they used to be. And I think one big criticism comes from construction, particularly residential construction, because I think residential construction, it could be easily argued that it's not as superior as what it was decades ago, that they're made to be built quickly and inexpensively with a minimum amount of detail. And that's one area that I think is a pretty good indicator of changing quality. And sometimes it's not always there. So it can go one way and it can go the other way, can't it? Some goods are getting better, some goods are not getting better. How do we know? There's no way for us to really measure it adequately. And there have been efforts to try to get around the quality of goods, because we're not getting quality here. This is all quantity. These are quantity measures. But yet quality is an issue. And so the only way we have of measuring quality is what someone's willing to pay for something. But maybe that's not good, because how do you know what the quality of a good is? There are some goods that have monopoly protection you've got to buy, whether it's a good quality or not. A drug that's new, it's under patent protection, is essentially a monopoly. You don't have any choice but to buy it. And so as a result, you'll pay whatever price. It's not like you're choosing to pay a price. So that's another issue there. It also doesn't account for all elements of standard of living, whatever that is, right? Leisure, public service, etc. So we have heard a lot about this in recent years, particularly the idea of where Americans, what our standard of living is versus other countries around the world. And it seems like in a lot of cases, the U.S. is sort of lagging other countries in terms of things like leisure in particular. There are a lot of countries in the world with a lot more time off, a lot more things like childcare available and all that. And we've heard a lot about the Scandinavian countries in the last few years. And this is where my grandfather came from. My name has been anglicized over time. So we're actually from Norway, but and that nation has, got a standard of living that's thought to be good, but the people pay higher taxes for it. And so the question is, how do we account for that? Standard of living, is it just about income? And maybe it's not about income. Maybe it's not all income over time. Okay? Per capita GDP. Per capita means what? Means per person, right? So those measures are only helpful to the extent that income is relatively evenly distributed. So what it means is this. So we've got $25 trillion of output, but is it evenly distributed in terms of personal income? Now, we know the answer to this, right? We know the answer, and that is the idea that it's not evenly distributed. Personal income is unevenly distributed. And what is the trend? Is it becoming more even or more uneven over time? More uneven. It's becoming more uneven. And this is an interesting question as to what this all means and where we go with this, because there's a lot of work going on right now to try to determine what the impact of that is. Is that a good thing or is that a bad thing? I think most people think it's a bad thing that income is so unevenly distributed. And so we'll see. And certainly President Biden is looking to impose new taxes on very high income. What's that?
Windfall tax.
Yeah, high income, high wealth individuals. I think the windfall taxes you're talking about are like the oil industry and whatnot. So, and I don't know that he's going to get any of that done. I mean, he's got a very hostile Congress right now, so I don't know that's going to happen. But it flows from this idea that maybe because income is not very well distributed, that maybe we need to do something about it. So that's a perennial question, but it's getting more extreme as income distribution becomes more, or maldistribution becomes extreme. And it also has to be adjusted for price level changes. So this is where we're going to go next. There's this idea of inflation and deflation, what it all means. And it's going to be sort of a precursor to where we're going with chapter 9 when we get into inflation. So let's talk a bit about this idea of price level changes, because we have to adjust for these. And so two concepts that we'll need to know about: inflation and deflation. They are basically the flip sides of the same coin, okay? So inflation is defined two different ways, as is deflation. They're just the opposite of one another. Inflation is a general rise in the overall price level that we see manifest in the physical flow, right? We see physical flow is goods and services. We see prices going up. Now, the key word here probably is general. And I want to make clear here that when we talk about inflation, we're not talking about specific goods necessarily, because I know sometimes people will focus on one good in particular and say, wow, look at the inflation in the economy. And gasoline always seems to be the likely suspect here. Look at the price of gas. There must be inflation going on. Well, the thing about gasoline is it's up, it's down, it's up, it's down, right? At the moment, it's down a little bit from where it was a couple of weeks ago. It's going to go back up, it's going to go down, it's going to be all over the place. You can't focus on single goods or even single categories of goods and say there's inflation or deflation going on. It's a general rise throughout the economy. And one of the reasons why is the second category. It's a fall in the value of money. It's monetary depreciation. If it takes more dollars to buy the same good this year than it did last year, it must mean your money is worth less. So as a result, the financial flow is how this is represented. And they're both this, again, they're the flip side of the same coin, really. If it takes more dollars to buy the same goods because those goods are going up in price, it must mean that value is not worth as much. Now, inflation right now is the big story, isn't it, in the economy? Much more than unemployment. And as we get deeper into the class, we're going to talk about this connection between inflation and unemployment. Now, it's a sort of an inverse relationship. Unemployment is very, very low. Inflation is pretty high, right? And so nobody's really talking about unemployment, but everyone's talking about inflation. And right now we're running at about a 6% annualized clip, at least in the last number that was printed last month, or actually just a few days ago, and that was for January or for December. So it's a general rise in the price of what to do about it. And so and we'll talk about what some of the steps are as we get a little bit further into the class. But we have to adjust GDP for inflation or conversely for deflation. It's a general fall in the price level and it's a rise in the value of money. So deflation, prices falling, a general fall in the price level. Okay. Now, this is a question that's an important one, and it comes up from time to time, and that is, okay, if you were to choose, right, sort of pick your poison, would you rather have inflation or deflation? In other words, which is worse, I guess, is the question. Is inflation worse than deflation or vice versa? Which is worse? Do you think? Any ideas? Which is worse, inflation or deflation?
It's like temporary.
I think, okay, you guys don't want to play along here, right? So you guys are a quiet group. So I think most economists would say deflation is worse. Now that doesn't sound, and it sounds maybe counterintuitive because it's like, what's wrong with lower prices, right? That sounds pretty good, right? Well, the problem with it is usually deflation is a symptom that something has really gone wrong with your economy. The economy's gotten the wind knocked out of it. And that's why prices are falling, because the demand is falling, and as a result, and usually that results in lower income, and everything starts to go in the other direction. The last time we had a true deflationary period of any length was the Great Depression, and prices were falling. And in some ways, though, the good news is that you can reflate the economy by just simply pumping money into the economy, so that that fixes the problem. Unfortunately, the Great Depression, they didn't know to do that, and they were also worried about the fact that they would be diluting the value of gold. Now, we're not backed by gold anymore, so we don't have to worry about that. But deflation is usually the symptom that your economy has gotten knocked flat for some reason. And so that's bad. Now, the last time we had deflation of any kind at all, I said the depression was something length at that time. Well, in 2009, we had a little bit of deflation, just a little bit, less than 1%, just a tiny amount of deflation. But the economy had gotten knocked on its back, hadn't it? And that was the first time we'd ever seen any amount of annualized deflation. But it only lasted a very brief time. So the Great Depression was year after year after year. This was a brief time. And what did the government do? Simply trying to get the economy inflating. And for years and years and years, our Federal Reserve talked about getting the inflation rate up to 2%, right? Up. Now, today, all we hear is let's get inflation down. But for years, they were trying to get it up and to 2%. And today, we're about 6%. We've come from and again, this is reported on a monthly basis. And we just got a number the other day on that. And it was about 6% annualized. If we just take the monthly figures and sort of annualize them, multiply them by 12. And so that's sort of where we are. I suspect that'll come down over time, but we'll talk more about that. So it has to be adjusted for those price level changes. And this gives rise then to a couple of other terms you want to know, and that's real versus nominal. These terms are going to come up again and again and again throughout the rest of the term. Anything that's a real value is considered to be adjusted for inflation. Nominal values are not adjusted for inflation. So it's sort of where we live in the daily world. Whatever our wage and salary is our nominal wage. I mean, what we spend is our nominal wage. It's really the fact that over time we have to adjust values for inflation. Excuse me, in order to keep it real, in other words, right? Just sort of straight a phrase there. Particularly over longer periods of time. Inflation from one year to the next, particularly when inflation is low, is not really that big of a deal. And for years and years, I mean, I guess probably for the better part of 40 years, inflation from one year to the next wasn't any big deal And so the difference between nominal and real on a very short-term basis was not that big. But when inflation picks up, it becomes a big deal, even year to year. And we have to adjust for those price level changes. And in order for us to make these adjustments. So when I say over time, I think we all know that things used to cost less back in the day, and in terms of prices. And we know that because of the fact that the economy has inflated over time. So if you're like me and you have older relatives and whatnot, then you'll see them say, I paid this back whenever, right? And like my dad says, when he started his job in 1946, I think he earned like $300 a year or something. I mean, today, $300 a year doesn't even, you'd be basically homeless at $300 a year, right? Well, we have to pump that up for inflation because there's been inflation since then. Or if you paid something like $200 for a new car, right? Obviously, those numbers don't stack up. The economy's different since then. So we have to pump those values up a lot. And by the way, one of the things that I should point out is that if you're ever watching, like historical documentaries, when I talk about, somebody in 1980 bought something and today's dollars would be worth this, that's really, really misleading because, first of all, the data wasn't very good then. We don't really know what the price index was. There's no way to compute that information. And what's worse is I've even heard this go back to things like the Middle Ages and the Roman Empire in terms of what the value of things were. It's like, that's really stretching things a lot. We just don't have any information to say what these were. We can, as a percentage of GDP, that's probably a better measure. If I bought a house in the Roman Empire, what's the percentage of GDP? It's probably better, but we don't know what the GDP was in those days. And so it's difficult. And really the data only, 1940 was sort of the year in which the data got better. And it was because of the emergency situation of the Great Depression. So we do this by using a price index. And so this is a market basket of goods. We're going to get into this a lot more in chapter 9 and talk about what these indexes are and how we use them. And so when we come back on Thursday, this is probably where we'll pick up. I'll just do a real quick calculation just to show you how we adjust from nominal to real, and that whenever we're talking about economic data throughout the course, we're mostly talking about real data over time. So GDP will mostly be real GDP unless we specify otherwise as by calling it nominal. But we'll get into some of this a bit more. That'll be the last thing that we do. And then we'll get into the next topic, which is unemployment, and that comes up in chapter 8. Okay? So we did a lot today, and we finished up our discussion of GDP, but by no means are we done talking about GDP. It'll come up again and again throughout this course. So questions for me about anything we talked about? Okay, well, I will see everybody on Thursday. Have a great rest of your day.